Gold continues to be one of the most talked about subjects in the market. Yes, there are certain other aspects of the market at the moment which many are continuing to discuss. Of course, cryptocurrencies is one of them, but gold remains front and center as we see much discussion about whether or not we're just due to about to take some risk off the table. Ron William joins us now from RW Advisory. Ron, good to catch up with you again. I know in just a few moments' time we'll take a look at some of your charts which indicate some of the major features of this market that we're seeing at the moment for gold. But let's kick off, if we can, first of all, with a look at the pure gold price and work out just what it's telling us at the moment.
Well, the opening and most important question is the gold trend still our friend? And many gold bugs have been asking this question since the start of this year in that correction from the all-time high at 2080. What's interesting, as we can see here on the real-time chart, we're having a recovery from short-term oversold conditions that is now retesting a line in the sand, the 200-day moving average, the annual benchmark measure for a trend up or down. And what's interesting, Jeremy, is if you see the base pattern box that you drew there on the chart, the line from that base pattern intersects with the peak pre-pandemic 2020. So markets have memories, and you can see there that although gold did have a sharp correction from the all-time highs, it did hold above the peak of the pandemic crash, which is a resilient sign for the gold market.
It's interesting you mentioned that 200-day moving average, the wavy red line on the chart, because this is an interesting point to pick up on, I think, for some participants in the market that use this for a specific purpose.
Yes, well, it's popularly referred to as the 200-day rule, and the successful fund manager Paul Tudor-Jones of Tudor Capital has spoken quite often about how a trend is your friend above a rising 200-day line, but he does like to play defense if the trend flips the other way around, and often says, get out the moment the market switches. And we can see that did happen in terms of that temporary defense play during the pandemic of 2020. That this is a monthly chart we're looking at. You can see the down monthly bar temporarily breaking the 200 line. So if you had a price and time filter at the time, that would have kept you in, or you would have looked to on a renewed buying opportunity on the bounce back. Either way, for 2 years, the line in the sand, that 200-day rising line, has kept gold bugs invested. And it was only year to date that we've had this corrective phase where the average is now flattening out. Now, the interesting and exciting news is that we're getting this short-term bounce back from oversold conditions, which is now retesting the 200-day. And we have this overhead resistance, which is even more important, between 1830 and 1880, which the gold market must break above to confirm a resumption of the long-term trend. That will be key. And just to give some quick detail on that, that's the 38.2% and 50% retracement of the peak to trough that we just saw, and a DeMark risk level as well. So there's quite a few confluence resistance levels there. The very last point is there are two risk cycles at the bottom right-hand side of the chart. One that kicked off early in the year during the month of Feb, which did create a mini shakeout in the market, both in Feb and March. And then most recently, the new one coming up will be in the summer months as part of the negative seasonality sell in May and go away. The biggest drawdowns are during the month of June, and then September, October as part of that fall crash cycle. All this means is an unwind in risk markets, higher volatility, and potential more safe haven flows back into the yellow metal.
And of course, one of the interesting things about gold is that we constantly talk about gold and we reference it in just one particular currency, that's the dollar. But we mustn't lose sight of the fact that people trade in other currencies. And of course, if you look at other areas of the market, you can see how gold has performed in so many other currencies. And it's of interest, I think, to pick up on this point.
Yeah, so it's really important to look at a breadth, market breadth, whether it be gold or in popular measures cross markets like the stock market. But here, even when we're looking at gold, we can look at breadth measures based upon gold versus a basket of currencies. And the bullish story for gold has been that it was rising to all-time highs, not just in dollar terms, as you mentioned, Jeremy, but also across many other currencies. So that includes the G10 or G3 complex, euro, pound, Japanese yen, and I've added a fourth one there, Swiss franc, for that safe haven demand, which is synonymous for the region. But then also some of the gold producing countries at the bottom of the chart. We have South Africa rand, Indian rupee, and Aussie dollar. But if we look at the chart on the left, we can see that year to date, they've been negative during the corrective phase, but only just recently have we started to see a plus 1-2% gain, gold and Swiss franc, followed by euro, and then in third place, the dollar. So for those of you looking to pick up on some lead signals in the gold market, it's actually in Swiss franc and euro, and then the dollar. And then looking at the technical charts, we can see the big drawdowns, the smallest being gold and Swiss franc down 17%, peak to trough, but the biggest actually in gold South Africa due to the emerging market volatility in that local currency. In terms of which markets are very close or actually right now hitting their 200-day moving average, that's gold in dollar terms, gold in Swiss franc, and gold in India rupee. So there's a few ways of slicing and dicing gold across other currencies in terms of year-to-date performance, but also the technical setup.
Well, let's look at what's happening with the wider picture on the currency markets with regard what's happening with the dollar basket, because we have seen wide differences between where we were pre-pandemic at the very top of this chart here on the top left-hand corner, and the big decline that we saw down over 14%. And we're not too far deviated from that lower line at the moment.
Yes, I mean, up until that recent correction on the dollar index, the jury was out as to whether the dollar king was alive, dead or alive, as it were. And now it is resuming that downtrend that we see there in the red box. And I think according to the percentage measure that you've drawn on the chart, it's down almost 15% from the peak, the pandemic peak of last year, to the most recent swing low. So the trend is down. Percentage-wise, it's 15% almost. And if we then look at the longer-term picture, we can see why this is so important.
Yeah, this takes into account the long-term going all the way back to the highs we saw back in 2016. So we've got this double top pattern here. What's the significance of reading where we are now from those two peaks?
Yeah, so the big picture, long-term technical view on the dollar remains negative. And if you added just a little bit more history on there, Jeremy, if possible, back to 2008, you can then see the long-term, the potential double top pattern in a long-term trend on dollar index as being, the demise of the dollar to come in the next few years. I mean, it's not an overnight signal, but certainly one to keep on the radar if we break below the double top, the multi-year double top neckline, which is around the 90 or 89 level, depending on how you draw that support level. But generally, it's a mega bearish picture for the dollar over the next year or so, if we break below that level, and that would be very positive for gold, given the natural inverse correlation.
Okay, let's return to your charts and pick up on a couple more points that I think are worth mentioning. And you talk in your pack about this parabolic rise for gold, and then we start to look at where it goes from where we are.
Yes, well, I mean, part of the long-term gold story is, which connects to the dollar, is as money printing continues, of course, the one shoe that drops is the actual purchasing power of fiat currencies. And so that's partly what we're seeing on the previous chart, gold outperforming against fiat currencies, and therefore hard assets outperforming paper assets, especially gold. technically, we can see here that it's part of a parabolic trend that's been up since 20 years. There's been a 6-year base pattern clearly on the chart there. The old acronym is the bigger the base, the higher in space. And so we did hit target at 2070 based upon a doubling of that base pattern. If we triple it, then that gives us a higher target at 2,400. I'm going even higher than that and suggesting a risk, spike risk into 3,000, the next psychological level. This is only if we get the break above 1880, and then of course an impulsive resumption of that trend, and that would be very similar to the 1980 gold spike, where we had a $700 rise in just 1 year. Not the easiest market to trade, I might add, because the fact that it's a spike means that you have to get in quickly and get out even faster. So just a disclaimer there, that fast-moving markets will be harder to trade, but certainly ones to hedge in this case. And then the alternative point here, Jeremy, if I can just quickly add, if we don't get the confirmation above 1880, there is an alternative bearish scenario for gold. So just to give that flip side view, and if that were to happen, a failure below 1880 suggests that the 2011 peak was a final true top in the gold market, otherwise referred to as a wave 5 in Elliott wave terms. And so that would give an alternative bearish structure to the market.
The other thing, of course, is how we read what's happening in the gold market when looking at risk assets. And I know the next chart you've got gives us more of a sort of a perspective on what we've got in terms of the dynamics in the gold market at the moment.
Yes, I mean, this is the intermarket reason as to why I actually am more of a gold bull than bear. The chart setups are looking attractive, but also if we look at the background correlations, we seem to be at a tipping point here in favor of gold, not least because real yields are stabilizing, which has been a gold negative. So you can see the inflation expectations potentially petering out for now, based upon that ratio chart on the top right-hand corner. And on the various other relationships I've got there, risk markets are potentially topping out in the short term, with S&P 500 unwinding from that exhaustion pattern, which with a key level at 4,200. And that's part of the Minsky risk, which I've been speaking about now for some time. And then on a relative basis, we have gold against commodities and equities. The ratio charts on the bottom left-hand corner starting to lose momentum on the downside and suggests that a short-term base is forming in favor of gold. And then finally, last but not least, the bottom right-hand chart highlighting that even digital gold, Bitcoin, as the poster child proxy, is starting to show short-term toppish formations against gold. So that's actually a potential rotation from Bitcoin to gold. We've been hearing the exact opposite year to date because of the phenomenal gains that crypto space has benefited from. Perhaps this is a moment to enjoy the champagne and either go into cash or gold, as opposed to take on too much greed. And certainly that's what the chart shows here. Bitcoin versus gold topping out at that ratio.
And of course, the other interesting thing about the gold market is that when we talk about the price of gold, that's just one way of approaching this. I know that you see an incremental $100 increase in the price of gold. That's all it is. It's just an incremental increase of that value. But when looking at it in terms of ways to lever that, you're looking at company profits, and an extra $100 of extra profit is worth an awful lot more in terms of upside potential for stock prices. And I know you've got a chart as well showing us how some of the individual stocks have been performing around this rise we've seen recently in gold.
Yes, so as a grand finale kind of chart pack final slide, we must talk about the stock picking side of things, because I mean, I know there are many stock traders out there, traders and investors that watch our discussion and like to invest in the equity space. And certainly the gold story is not limited to gold or even gold and other currencies. It's also gold mining stocks. Now these were the unloved darlings of 2011, partly because the market took such a strong hit, balance sheets were quite inflated, and now we've got the exact opposite. More so because of a recent bullish signal that took place April 20th, what I'm calling the FANG to BANG crossover. FANG is the acronym that we know. It's the tech giants of our age: Facebook, Apple, Amazon, Netflix, Google. BANG is the gold mining opposite: Barrick, Anglo Gold, Eagle Mine, Franco-Nevada, and Gold Fields. And essentially, we have the black line on the chart on the left showing the FANG index peaking in February this year, then having a second lower peak in April, which was the crossover signal I'm alluding to. Black line going down, that's FANG. Green line going up, that's Franco-Nevada, followed by Gold Fields. So for those looking for some stock names. And then if we look at the chart on the right, the series of charts, a number of pretty looking price patterns suggesting further upside ahead for the gold mining BANG complex, in particular Barrick Gold, Anglo Gold, and others mentioned there at the bottom.
So Ron, in sum, just to quickly recap where we are, and I think perhaps possibly best to return once again to this gold chart and just summarize very briefly on how you see this market developing.
Yes, so a very attractive gold trend resumption, which we're already seeing right now as we test the long-term moving average, 200-day moving average. But we do need to see that sustained break above 1880, which is the overhead resistance zone. And I think once we get that, then it's a good buying opportunity back into the old highs at 2080 and much higher, potentially 2,400 or more. And just be aware of that scenario versus an alternative if we don't get that break. All the charts we've looked at are suggesting that the probabilities are for the break above 1880.
Okay, Ron, lovely. Thanks indeed for joining us. Interesting talk through some of those charts. That's Ron William from RW Advisory. For more videos from us here at IGTV, join us on Twitter at IGCom and subscribe to our YouTube channel.